right, we should be good now. So, all right, again, for the few that were here before we really get going, I just said that this call was going to be really short. This is more of I'm going to show you something that I do, and then, if you're using the concepts that I'm using, this should resonate really well with you, and it's just really a way to manage risk, and really focus on the entry, exit, and take profit, right? And exit meaning, stop out, right? And this way, if you use it using this methodology, I guess you could say, it really, to me, it kind of takes a lot of the stress out of this thing, right? It's stressful enough when you're trying to find a trade, you start, oh man, I don't have anything right now. I know everybody feels that way, and that's okay when you get, more experience. I think instead of thinking, oh man, you say to yourself, all right, nothing for me, let me go live my life, let me do something else, right? But there's enough stress associated with trading that I don't think the entry and exit should be a problem. And I think if you map this out prior to your entry, or before even considering the trade, and knowing that, does it make sense, yes or no, before the trade even occurs, I think it could take a lot of the unnecessary headache out of things. So just first and foremost, again, this works, this applies to everything. It doesn't have to be futures, it can be stocks. It really, really doesn't matter, right? But if we were just to look at this right here, right, and it doesn't even matter, right? We can be wrong still as long as we have structure to the trade idea. So first and foremost, I'm just going to map my range right here, okay? So ready, first things first, do we get into discount? No, we do not. Therefore, right, this is a bullish fair value gap. We can justify that, but this is not necessarily the move that I want, right? I want a discount retracement. And unfortunately, you don't get it. You get this huge rip up, and I believe this was Friday. Yeah, it was. And it is what it is. So be it, right? So all that's telling us is that the range isn't set, and you're going to notice that each one of these red candles, the range is not set until we got a range setter, okay? Now, how can we view this and how can we map this trade out before it even happens, okay? So we know that we got this market structure shift to the bull side, okay? Boom, okay? We get our first little imbalance move down to the downside right there. Woo, there it is, okay? Now, upon this move down into discount, okay, we could start, I personally start to salivate a little bit when I see that we're approaching that discount of the range, especially when everything lines up on the higher time frame. It's just, slam dunk to me, right? And the way that you can look at this, and this trade itself, it had, another, in my opinion, more clear-cut entry and exit and all of that, but that's besides the point. It's just a matter of how we can structure this before we even enter the trade, okay? So the way that you can look at this is you see that you have that imbalance down here in discount, okay? And you say to yourself, okay, well, I like that discount bullish imbalance, and this can go for any type of imbalance, right? I tend to add off imbalances. So if you're not somebody who's using the imbalances concept, then or breakers or anything of that sort, then unfortunately, you might have to figure out your own way, because I don't use garbage moving averages or RSI or any of that crap, because to me it is not as accurate and it doesn't give you as much structure as this can, okay? But before this entire trade is out, even setting itself up, we can view this and say, okay, well, we have this bullish fair value gap here. Okay, let's just think about this. If I add off the high of this imbalance, okay, being my entry, it doesn't always have to be the high. You can wait to see if it gets in and starts to move out. Your entry could be late, but if you need that extra little layer of confirmation, then that's fine, right? There's no strict, you need to do this, you need to do that. No, you don't have to. You can be late as long as you know where price is ultimately going, buy side, right? If you've identified the correct draw and liquidity, then it really doesn't matter, right? Or you could say to yourself, okay, I want to buy off 50% of that imbalance. Or you could say, I want to see it fill, and then from there, right? So you can structure the entire thing, right? I tend to go off the highs. Again, this is not, you don't have to do this. Oftentimes this will open you up to a little bit more risk, but I'm okay with taking a little bit more risk in certain situations, as long as the potential stop out makes sense, okay? So since I brought up the stop loss, how would I map that out, right? Okay, so if my entry, let's just say my entry is going to be off the high here, okay? My stop loss in this situation is going to be the low of the candle that created the imbalance. So the imbalance is here. my stop loss is just going to be below the low of the candle that created that imbalance right there. Okay, so before that trade, I'm going to know, right? This is a wide example, but okay, I know if my entry is 476 and my stop loss is down here at the low of the candle that created that imbalance, that's potentially 70 points, right? Whatever the exact number is, 75 points. Okay, does that make sense for me for a potential blank award, right? Buy side, 755. Does it make sense? Does it not make sense? That's up to you for you to decide, right? Now, everybody's different, right? That, let's just say, for example, oh no, that's way too big for me. Then there's no trade, there's no opportunity, right? You could go down to a smaller time frame and see if maybe a 5 or even smaller than that, if there's an imbalance in that time frame that really limits the potential risk even more, and you can give that one a shot, right? But to me, the higher time frame, I tend to use that as the compass and trade off of that. Of course, if I'm looking for setup on the hourly, I will use the 15-minute to kind of guide the way. Even the 5, if you got a big imbalance like this, maybe I'll drop down into a 5 and see if I can kind of trim out some of this fat here, because this is a pretty big range for me, right? But again, if we're talking about the entries and exits, and the only reason why I'm bringing this up is I feel like a few people were kind of on the fence, like, oh, I'm still trying to figure out the entry, the exit to it, right? I gotta just put this out into the universe. I do not ever, 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 ever trade off of Fibonacci. Okay, these are just measurements. What I really should do, and just for optics, literally get rid of these, because I don't care at all. Not even the slightest. Doesn't matter to me. The only thing I care about is 50%, so I know where discount is, and that's it. Other than that, the Fibonacci levels to me are useless. If there's no imbalance accompanying the 62 to 79, right, that golden pocket, of course that's a nice discount, right? Because in that certain situation, if you're buying off the 62 to 79%, that means your upside potential is 62 to 79%, while your downside risk is, what is it, 21 to 2, 3, I'm bad at math right now, 62, whatever, 100 minus 62, but that's your downside risk, right? 48% of the range, okay, or 38%. I'm sorry. See, told you I was bad at math right now. But that's just a way to structure the idea. I am not ever, ever, ever using Fibonacci. I've never seen, and look, maybe because once I learned these imbalances, maybe it was a little enlightening for me, because I used to mess around with the fibs and I would use them, but again, it was very wishy-washy. It wasn't as precise, and that's why I don't use them other than if there's an accompanied imbalance. Now, that 79%, I'll give it to you, right? When there's an imbalance at that 79%, to me, that's golden. I'd love to give it a shot there. And why? What's the reason for that? I'm risking 21% of the range to make 79. That makes a lot of sense to me, knowing that we have a certain structure, whether it's bullish or bearish, and my upside is far greater than my my downside in that situation, right? So that's the only reason why the fibs are in this situation whatsoever, right? If there's no imbalance, I am not playing fibs, right? So I just want to make that clear. Without the imbalance, there's no trade. So to me, that's really helped me become much better, because on those days where I would just be mashing buttons, like yesterday, I believe it was yesterday morning, when we really weren't forming any sort of imbalance whatsoever, I just don't do anything, right? Because if there's no imbalance, there's no trade, and that has helped me avoid those choppy conditions, which historically, I know this is just me speaking, but I'm sure a lot of you can resonate with this, but those are the days where I usually get smacked, and it's really bad on my mental, because I'm like, I know I should not have been trading right now, and I'm still doing it, right? And that's stupid. So if I don't see the imbalance, then there's no reason for me to even consider pressing buttons, right? But again, everything is well structured from the imbalance. Whether you have the imbalance as your entry, any point in that imbalance, whatever you might be, right? Whether it's a 5-minute, whether it's a 1 minute, it doesn't matter, right? Everything can be structured differently. So now if you want to zoom out and look over here, you could say to yourself, well, I don't want to get in that 15-minute imbalance. Let me pull it up to the side, because you're going to see something that I think is pretty enlightening. Now let me shrink that for a sec. Now let me come over here and pull up a 15. And I'll show you this would be a perfect instance where I would not be looking to, where the heck are the numbers here? Oh my gosh, hold on. Here we go. This is a perfect instance where I would not even be considering buying the high of this imbalance right here on this 15-minute time frame. Ready? So, right, this was our range. Okay, here's our discount 15-minute imbalance, right? So I see that big 15-minute imbalance, right? That's a big range, and my potential risk on this is a little bit too big for my liking. Now, if I were to drop down into a smaller time frame, where are we? Over here. Let's zoom over. Okay, and we come on down, bring it a little bit tighter. Now we can use this, see this imbalance right here? It's smaller, right? Do you notice how I'm trimming off some of the fat off that 15-minute larger imbalance, right? Just trimming some fat, and that saves me, I don't know, a couple points, but a couple points could make the difference, right? That would just be one example on where going down in time frame to kind of minimize your potential risk in a situation is not a bad idea. Knowing that you have an overarching imbalance and the overarching trade idea is still coming from the higher time frame. You're just trying to be a little more precise by using that smaller time frame. Okay. Now here's just another example. Let's see. In this situation here, on this second little go round right here, right? It was only one tap, so it really didn't make much of a difference. But when viewing that imbalance, you could say to yourself, well, I want to see turtle soup. There's your turtle soup, right? If you were unsure of this being considered turtle soup, right, because this is technically a low, right? You notice these wicks here getting you deeper. You can have your entry underneath, right? That at some point, whether it's 50%, whether it's right off the top, knowing that this is my stop out. Okay, so for every one, it doesn't matter. That's how I'm structuring it. I'm using the low of the candle that created the imbalance as my stop out, and there's no ifs, ands, or buts, because there used to be, and I kept, doing silly things, and then you are chasing, right? You're chasing to get back green instead of thinking logically and saying to yourself, well, if I just get stopped out, once, then or once or twice, one trade and I'm good. Right? But if you let that get out of hand, it's going to be really, really difficult for you to come back from that. And you're probably going to stress. You're probably going to come out of your strategy and start to just really do anything to try and chip away and make some money or get, grab some points. And then, it gets out of hand. And then you're back at square one, right? So that's just the idea on entries and exits. If anybody has any questions about that, please type it in the chat and we'll go through it. Now, this is what I challenge you guys to do after we get off here, because again, like I said, this is going to be a short one. I don't want to overcomplicate this really at all. The most important thing to me, find the draw on liquidity, right? So how do we find the draw on liquidity? Identify the market structure, right? Are we bullish or are we bearish? Preferably on a higher time frame. Now, if you're bullish on, whether it's, I think the highest probability is one way on the weekly, check. Same way on the daily, check. Same way on the hourly, check. Break it down into a smaller time frame to pinpoint your exact entry and exit. You're golden, right? That's the way that I look at it. And I want those all to check out. And to me, that will give me the highest confidence in order to take a high probability setup, right? But that's, ultimately coming from, okay, what's our market structure? Is our market structure bullish or bearish? Are we in discount? If we're bullish, then we're identifying buy side liquidity as a potential target, right? And from there, okay, if that's the case, then I want to discount bullish imbalance right here. Does this make sense, right? This is why I don't get, sometimes people are, they'll be like, oh yeah, a contract like got out of control on me and stuff. And this is what I'm actually challenging you guys to do. I want you to go to, whether it really doesn't matter. Any chart, any trade, any time frame, doesn't matter. Preferably use Webull because you'll be able to track the contract's price. Go in and just see what was the price of whatever the contract was that you would, typically get, whether you're at the money, whether you're a week out, whether you're 2 weeks out. Just see how the contract reacts, whether it works or not, right? Whether this is a winning trade or whether it's a losing trade. Just see how the contract reacts. And that way, and again, this can be done prior to the trade as well. If you just look at the delta, they usually have a little thing for delta. You'll be able to see what the dollar amount change is per contract, right? So you might not get it, pinpoint perfectly, right? You might have to do some serious, or I shouldn't even say serious. It's relatively easy math, but you'll be able to have an idea of how much money you could potentially lose if it hits your target. So you shouldn't go into the trade not knowing, oh man, that got out of hand, I didn't think it was going to be that bad. No, you should be, you can do the math prior to it, right? Just look at the delta, right? That's your dollar change. The amount of money you're going to gain or lose for a dollar difference, right? And then of course, if it gets more, then you have to add in your gamma to that. But you can get a ballpark idea, right? So I'm going to just do one really quickly so you guys can see, and preferably a loser. Okay. Actually, it doesn't really matter. It really doesn't matter at all. No, that's not. I don't really see anything. This has been a mess. Tad higher, relative equal lows, relative equal highs. So it's really not giving us much of anything. Let's see. Oh, okay. So end phase. Here we go. This is the trade that I took yesterday. So here's end phase. This is a 15-minute time frame. Okay. You'll notice that there's an imbalance deep down there. Okay. Now, my model completed here on the 15-minute time frame. But how can I structure this thing knowing how much money I could potentially lose on an options contract, right? With futures, it's simple. It's right on the screen. It'll tell you what your risk is in terms of money at a specific place. But if you're using options, you got to, kind of use your head a little bit. So you have to have an idea of what the delta is going to be in this situation, right? So let's just say my delta on end phase is $50, the contract that I chose, right? 50, easy number, round, not bad, okay? And let's say I paid, $2. So $200 for one contract of end phase right off this imbalance, deep in discount, 126.36, okay? To me, this trade is going to go bad at 125.85, okay? No ifs, ands, or buts. 125.85. That's where I know it's going bad. So that in itself that's less than $1, right? That's 50 cents, right? So if that's the case and my delta is X, whatever it was, 50, right? I can do a little math. I can get a ballpark idea, right? Because if it's $1 move down, then I'm going to lose whatever that delta is giving me, okay? And just have an idea that, okay, that $1 move is worth X amount of money. And that way you could structure this and you should have somewhat of an idea of, okay, if this trade fails, I can ballpark at how much money I can lose. Now, on the flip side of that, at 126.36, knowing that my target is going to be buy side at 128.88, I know, okay, this is a $2.50 reward for a 60-70 cent risk. Okay, right? Now I can even kind of ballpark how much money I could potentially make. If my delta is 50, my gamma is 3 or 5, whatever. Let's just use 5. It's easier. For every dollar this moves up, so at 127.36 right here, okay, that's $50 on the contract. Now for every additional dollar, I'm adding in that extra $5 of gamma. Okay, so now for that next dollar, I'm going to make $55 on that next contract. Okay, so the next dollar would be 128.38. Great. Okay, so that's $100, right? And now 50 cent, another 50 cents. That'll be what's half of 50 or 55, your delta, so another $27. So that's $127 to risk. Let's say the delta was 50. Downside, right? My downside move is what am I risking here? 36 to 85. That's 50. Let's just say 50 cents. I'm risking $25 to make whatever it is, right? And that's just a way you can ballpark it, right? But when you're down here and you just see it, right? You might oh, I got to get into this, I got to do this, and you don't think it through. But that's why I urge everyone to put in a little bit of time at night, mark out some key areas where you'd be interested in adding something, whether it's deep in discount, map out the imbalance, set a little alert. It takes 2 seconds. There it is. Boom, create. So I know that if price gets here, I should at least get eyes on to it. And that way I can start to kind of create some sort of game plan, right? For options, it goes beyond just Here's the low of the candle. Boom, my stop is right there. Yeah, you might have to do a little bit of math for it to make sense in order for you to actually figure out the monetary value of what you're potentially getting yourself into. But before every trade, you should have an idea of how much you can potentially lose, and it shouldn't be 100%. And then on the flip side of that, you can have an idea of how much you're potentially could make as a result of just using delta as a tool. Theta, of course, comes into play. That would be if you're using a shorter dated options contract, and your theta is going to subtract whatever it is from that con's overall value. So that's I know we don't really talk about any of that stuff, but that stuff, if anybody wants me to get more into that, I can definitely do so. But those are very, very paramount to just have an idea of, so you kind of have an idea that, okay, this is what I'm what I'm in the mix for. Does this make sense for me right now? If it doesn't make sense for me, then there shouldn't be a trade. If it makes sense for me and I can stomach that loss, so be it, right? Those are just, again, little strategies for how you can enter and exit, and then also prepare and plan out that trade before it even happens. So